range.
April LaRusse joins us, Head of Investment Specialist, Inside Investment. April, the wash-up from the weekend is huge. We're seeing it already across on European markets on early futures. But when it comes to the interest rate hike, Goldman Sachs pulled the 50 basis points off its playbook. Still has uncertainty around 25 basis point moves from here. But what do you think? Are we done now in terms of the 50 basis point move from the Fed at its next meeting?
It's actually interesting. We were looking at that on Friday and looking at how much was priced in. And actually the market's now pricing in more or less a 50-50 chance of a 50 basis point hike. So it seems like people are pretty divided whether they do 50 or whether they do 25. Our expectation is that they will do 50, although clearly the news from some fragile parts of the banking system might give them pause. But I think what's interesting is what they're doing. They're obviously trying to provide liquidity where it's needed, lending where it's needed, reassure people regarding deposit insurance and even beyond that. So that may be enough to stabilize things and allow the Fed to continue doing what they say they're going to do. They're talking hawkish, and they're probably going to actually continue to behave hawkishly.
It was a big debate over the weekend of just how far authorities would go to try and stop contagion, including printing money to help some of the depositors, but in providing a safety net for those that may have got the maturity profile at the bank wrong to now tap a special window over at the Fed. If you think about what we're seeing on markets today, First Republic, Arabella just showed us the calls on that. We've got some red ink now flashing up on some of the banks as well. Contagion risk hasn't disappeared this morning. That's a problem, isn't it?
I think they're going to be looking very carefully at exactly where are the interconnected possible risks of contagion. But I have to say, this is quite different from 2008. I mean, we don't have banks with a lot of bad loans on their books. We have a situation where they basically have the carry trade on. You know, they're obviously having purchased longer dated securities which are ultimately money good, but obviously have a big mark-to-market loss. So if there can be enough put in place by central banks to provide that liquidity window, then actually it's not a situation where you would expect to see problems throughout the banking sector systematically.
While there is a recovery in the US, there is still a sense of volatility, especially across Europe. You see that continuing as well?
I think markets are intimately connected, so yet you are going to continue to see volatility as everyone tries to figure out what this exactly means. But I think if we take a step back, we still have a situation where we have far too much inflation, and we have pretty much all the central banks talking about how they're very serious about getting that under control. So, you know, I don't think this will stop the path of further rises in interest rates.
Should there be different steps sort of taken as well in the banking sector, considering what's just happened now?
Well, I think every central bank will be thinking about what the Fed has just done. You know, setting up a new lending facility to provide banks with some breathing space, being a little bit more flexible on their discount window, doing all the things which are there to make sure that a bank doesn't have trouble because of short-term liquidity issues. Clearly, they do not want to bail a bank out who's got a lot of bad loans on their book. That's a very different situation.
One solution to keep deposit money sticky is to lift the interest rate, make it more appealing. Doesn't that mean that the earnings profile of a lot of the banks, it's just wrong now? The investor community got it wrong around the NIM story.
Yeah, it's interesting how long it seems to have taken for banks to pass through those higher interest rates to savers. I think that you might see some readjustment of that across banks, making sure that the savings rate is quite appealing to keep depositors' money in place. But I do think post-financial crisis, most consumers, if they're with a mainstream bank, particularly the large money center banks, will not be thinking they need to run for the hills. But certainly it won't help to give them just that little bit more on their deposit rates.
April, thank you very much for joining us this morning.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.